Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing a weekly market update. I want to jump right in, share my screen with you. Hope you all had a great Thanksgiving. Really appreciate you guys. Hope you had a lot of fun. Hope you had some downtime with your family. And, this time of year is a great time to kind of recharge and do that, right? So we love you guys and hope you have time to do that. And if you guys ever have any questions, always feel free to reach out to us. I am more than happy to answer questions. We did get several questions in this week through social media and our weekly email. And I just wanted to make sure that we go ahead and get those questions asked. And one of the questions we get asked is, where are things heading? Are things really the doom and gloom that we hear a lot on the mainstream media? I'm going to play a video I just made and post to the social media. I'll be sending this out in our weekly email too, but just to kind of give you an idea of what I think is going to happen and what's going on right now. You can see that headline, right? So let's take a listen to this, and then I'll break into the rest of today's webinar. Hey guys, look at that. Woo-wee. For all those who said the housing market was going to crash, there you go. And it's not going to stop. And here's why. First week of January, we're going to see searches start to spike. Then we're going to see properties pending the following week in January, pendings spike. Then the first week of February, we are going to see closings spike. Why? Because it's what happens every year, guys. And there you have it, guys. That in a nutshell is what I'm predicting what happens every year. And it's always a cyclical tale. People get lots of money to be on mainstream television to talk economics. When it comes to housing, that's what happens every year. Even in the worst of markets, which we are not in, we're just in the Phoenix area anyway, we're just kind of in a balanced market. That's really all it is. Historically, we're not crazy on rates, even though we got spoiled for a few years there with those, 3%, even 2% rates. But it's what happens every year. There are transactions that are done every day, every week, every month, every year, no matter how bad it is. And we're not in a housing crisis right now. We are in an economic issue, and that's why, with inflation, and that's why they've raised the Fed's fund rate and everybody's paying so much to borrow money. When you borrow money, that's an inflationary factor. They're trying to stop that. That's just kind of how our economy works, whether you like the Federal Reserve or not. It doesn't matter. That's just how things are designed right now with fiat currency. So this, I think, kind of spells out what we've been saying right along here for this year. It's not to say something could have come out of left field. Of course, that can always happen. But what the data points are telling us is exactly what we've been telling you and what's been happening right along. So let's take a look at some quick news here and headlines. Hope ahead for housing inventory, ? Weekly jobless claims decline more than expected. And what an important recession indicator is saying. So as far as the inventory, that's supply and demand. That's always what we look at, right? We always look at that as our main data point, typically, and what's happening in the market. So, there is, I'm just going to kind of skip to the bottom here for this. Yet there was positive news for buyers as well as sellers. NAR's chief economist Lawrence Yun noted that housing inventory is expected to improve heading into the spring. One of the issues we're having is we just don't have enough homes to sell or enough options for home buyers or for people who maybe are thinking of downsizing or upsizing. They're just like, I want to move, but maybe they're just not finding what they want. Okay. Whether it be a brand new home or a resale home, they're just not finding it. So we're seeing that, they kind of point out here, there are 1.5 million homes available. This is across the country for sale at the end of October, down from 1.22 million a year earlier. And nearly half the level seen of 2019. So, like in the Phoenix area, I could tell you, we're running, I don't know, somewhere around, depending on the day and the week, 14, 15,000 homes for sale right now. We've been running it kind of steady at that for quite a while. And that is really about half of what we would want to see typically, right? Almost half what we want to see typically in our normal market. Our inventory increased a little bit just because there's less transactions. If I had to say, what's the issue with the housing market right now? Well, inventory being one, which really new inventory are new home builds, new home sales, right? Because usually if someone sells a house, they're also buying a house, so that kind of cancels that out. But the issue is that there's just not enough of these properties out there for people, and then we fall into these issues where there's just not enough of the properties being absorbed at the same time. So our inventory increased a little bit. So we're kind of in a housing transactional issue right now. There's not enough transactions, but there's also not enough inventory, which kind of balances that out and keeps a steady pressure on the rise of overall across the board, the average price going up. Okay. So that's across the country and in the Phoenix area. That's just the general thing of what's going on. Obviously, every area is a little different. Every community, every state, every city, whatever. Weekly jobless claims decline more than expected. So, it says here initial jobless claims fell by 24,000 the latest week, as 209,000 people filed for unemployment benefits for the first time. This decline was larger than expected and comes after first time filings hit 3-month high the previous week. So, basically we look at these jobless claims because we want to know, is the Fed getting to where they want to be? Or they want to know, are we getting to where we want to be on destroying, this spending that's going on? Part of the way they do that is people losing their jobs. People don't have a job, they can't spend money, right? They aren't making an income, they can't spend money. So although that sounds counterintuitive, that's what they're looking to do to quote unquote improve the economy. This is how they think. So they want less spending, less inflation, less too many dollars chasing too few goods causes this inflation. Part of that also is how much money Congress allows to be spent, right, in their annual budget. So, and in their budgets that come along, and that's why you always hear this talk about the CRs and the omnibuses and all this stuff with the spending. And not to get too deep into that, but that's just, the more money we print. I think we've printed, what was it? $1 trillion we printed just in the last few months of spending. I mean, that like unheard of numbers. So beyond what we did during the pandemic and everything. So, the bottom line here is jobless claims remain relatively low on a historical basis, suggests that employers are trying to hold on to workers. And while continued claims decline in the latest week, they have risen overall by 182,000 since September. Now, keep in mind, and I broke this down in another chart in a previous video a couple of weeks back, where I've told you this before. A lot of these jobs that people are having right now are second jobs, or they've got multiple part-time jobs, right? So they're getting part-time jobs, 1 and 2 part-time jobs to supplement their full-time job because the cost of everything has gone up. Like whatever it is, almost 40% almost in a lot of cases, I guess, across the board. On average. So this means that, they're having to figure out ways to make more money, right? And spend less if they can. And that's the idea of the Fed, is they want people to spend less. Okay. So employment is a big piece of that. Another huge indicator in the economy, this is big, guys. Leading economic indicator, LEI, fell 0.8% in October, which is the 19th consecutive month of declines. Keep that in mind. In 19 consecutive month in declines. The LEI tracks where the economy is heading and its trajectory. Okay. So remain negative, and its 6 and 12-month growth rate also held in negative territory in October. So this idea here, the bottom line, historically, once the LEI turns negative, we have seen on average a 22-month lead time. 19-month consecutive decline. Okay, so normally we see a 22-month lead time until the U.S. enters a recession. Everybody's worried about a recession. Are we in a recession? Were we in a recession? Many times when we're in a recession, we don't actually officially hear about it from the government, our government, for it could be 2, could be 5 months before we hear about it, or maybe even longer. So that's just kind of the average time we hear about it. So we may have already been in a recession sometimes, and we hear about it after the fact. So this is telling you we've seen 19 months and on average in 22 months lead time until the U.S. enters a recession. Okay, so this is gold info here for people who are interested in this kind of thing and want to know what's going on. In fact, the last time we saw a stretch of negative reports like this was 2007 and 2009. Now, wait, that was a housing recession. We're not in a housing recession. We have nowhere near the inventory to have a housing recession. Okay. Again, anything could change, I guess, but we're nowhere near those levels. So what typically happens, it says right here, while a recession is not a great thing for the economy, one positive aspect of that period, that periods of recession are always coupled with lower interest rates. And if you go back and look again, outside of 2008, you will see that we have housing doing great during recessions, except for 2008, because that was a housing recession. The other recessions, housing did great because rates went down and people bought homes. Okay. But Chris, people go out of work in recessions. That's terrible for the economy. Yes, but if rates go down 100 basis points or 1%, okay, that means about 5 million more people can go out and buy a house. That's just statistically how that works. So anyway, that's just a little bit on that. Now, this is to be expected. Everybody's like, oh, well, we don't know yet. Well, we knew that they put a pause on rates. We knew that he was going to be talking, in code, meaning the Fed Chair Powell, who's an attorney, not an economist. And that's why we're in this mess. But calls talks of cutting rates premature and says more rate hikes could happen. Well, of course, he has to say that to get through the holidays where people spend the most money, usually out of the entire time of the year seasonally, right? Totally makes sense. Have everybody on edge. Don't want the markets to go crazy yet. Okay. Or build in things that maybe might be premature. But we expected him to talk like this until they start actually lowering rates. And what they're going to be looking at, obviously, are all the indicators. How the CPI is doing, on inflation, of course, which has been going down. Believe it or not, it's been decreasing. It's just that we were all the way up over 9%. So everything is crazy priced. And it just, we're just paying more for everything. But it has year over year and month over month been decreasing. Okay. So that's good. And then we have the unemployment thing, which we already talked about. 10-year Treasury, the other big indicator there, because that historically runs about, in the retail mortgage market, runs about 2% difference. Okay. But right now it's running at about a 3% difference, which we talked about because our economy is so messed up right now. So, thanks to all these economic factors, one of them being energy, which we've already talked about before and shown the proof of that and the articles and the data, along with what the Fed didn't do earlier on and so on. So this is, again, that's where we're at. That totally makes sense with where their 10-year Treasury is. And again, when you see these are average numbers. When you see this 30-year fixed, It's been trending down overall, because we were all the way up at 8 because the 10-year treasury was at 5. Okay. Again, that 3-point split, right? So that's trending down. That's good. And we also see home buyers perk up as mortgage rates hit lowest level. We just saw this in the last few days and week, and 2 months. Okay, lowest level in 2 months. So these are all great indicators. Lawrence Yun, the National Association of Realtors chief economist, believes mortgage rates could remain in at general level around 7% for most. Whenever you hear these mortgage rates, guys, always remember they're talking about retail market. We work with retail. We can work with a retail lender. We have a couple if we need them, but we normally would refer our clients to mortgage brokers. That's wholesale lending, less in fees because less in marketing. Also, usually their rates are going to be at least around 25 to 50 basis points cheaper. So 0.25 or 0.5 cheaper on your rate. So talk to us about that. There's also new home builders right now that are offering, I've seen, I mean, they all have different offers where they're, maybe giving a good price on a property. They're also throwing in lower rates. I've seen as low as like 3 and 4%. It's insane. Why? Because they buy these in bulk, these products in bulk, and they basically pay down the rate. Just to kind of put it in layman's terms. But anyway, he says, I believe we've already reached the peak terms of interest rates. He told attendees, like many do. Again, Feds just got to talk tough. And November NAR convention, within 2 years, he said the rate should return about 5.5 to 6%. And then the Assistant VP of Forecasting and Analysis, NAHB, agrees predicting rates will drop to about 6% by mid 2024. Now, I'm going to tell you, I think that they're correct in the retail market. I think that by the end of next year in the wholesale market, we're going to be in the 5s. Okay. We're going to see this really start picking up around the second and third quarter of next year on the rates dropping. But we're going, unless something comes out of left field, and we're in election year, so things got to look good for everybody, right? You got to throw that in there. But we're going to see 5s or so. But all this is due to all the spending, guys. It's bottom line. Okay. So they're just trying to tame all that. And it's the spending they did, meaning the government. Okay. Anyway, let's get back to the local market here. I want to get to some local market trends real quick from the Crawford report. We're seeing builder permits are definitely up a little bit, but nothing crazy. They're at 7143 for the third quarter. And single family permits, nothing crazy. Certainly nowhere near the highest levels ever. Some people are saying we're going to have too much inventory. It's just not the case. I'm not even going to get into a couple of the articles that say this thing. There may be certain parts of the country, but in Phoenix, we're just not seeing that. We're just not seeing that. The demand is still strong enough where we're just not seeing that, guys. So we don't have to worry about having an oversupply. In other words, sales per month. We are definitely have seen a decline, but this again happens every year from about August on. We usually get like a little rush, but at the end of the year, there might be like a little rush that we see, at the street level, at our level. But typically, things just slow down this time of year. People are like, look, if I haven't sold it now, if I haven't bought it now, I'll just kind of hang. But these are usually the best time of the year, whether it be new or resale homes, that you can get the best deals. And for sellers, if somebody is looking to buy right now, that is a serious buyer. Okay. That is a serious buyer right now. So do not discard that if someone wants to look at your home. Okay. This is my opinion. But anyway, overall, we are in the Phoenix area. We have the Crawford report. Anything below 190 on their index is a buyer's market. Anything above 110 is a seller's market. And right now, if we look right here in the middle of the index chart, we're at 105.6. So that means we're pretty much right there in the middle in a balanced market. We're just in a normal market. There's nothing to go, chicken little, sky's falling, crazy stuff's happening. If these two numbers are the same, we're in a total balanced market. They're just kind of right near each other. We're in balance, guys. Okay. We're seeing our demand with the lower rates have certainly taken a little bit of a jump, but this is a slower time of year, so people are a little bit slower to get off the bench, but they're there. There is so much pent up demand, guys. I am telling you, I'm predicting 10 to 15% equity gains next year, just on the pure fact that it's been almost 2 years. By spring, it'll be about 2 years since this inflation and these higher rates started kicking in. Just from that alone, people are going to be like, I got to move. I can't wait anymore. I got to move. I got to go live somewhere anyway. I got to pay rent, or I've got to sell my place and move on, whatever. And one thing to keep in mind too, guys, on rates, people are a little bit rate crazy because we got so spoiled for so long. And I get it. I totally make sense that you're thinking about these things. I get it. But think about it like this too. If you're selling a home and you have other debts, like credit cards, car loans, furniture, whatever, a blended rate, let's say your blended rate, everything together, let's just say is around 6%. It might make sense to get the equity out of your home by selling it and putting some money down on a property, maybe even if you had to do a little less than you might normally do or think you might want to do, but pay off the other stuff, not to have all those payments every month, not to have all that headache every month, those other higher rate cards or trade lines just paid off. Might be something to think about if you take your blended rate, all the other rates on all the other debt together with the home, but you've got that equity in your home, which is how most people build their wealth, through their property values. Okay. It's something like 44 times more, a homeowner is 44 times more, equity rich or has more wealth than a renter. Guys, if you're, the only way I would rent is if it was going to be a temporary situation or I wasn't sure about an area, maybe. I get that. So, but I would not do, if I was going to be in a place for more than, let's say, at least 3 to 4 years, I'd buy. Okay. That's just what I'm telling you. All right. So anyway, balance. Good year. As far as the individual cities, we like to kind of point this out to you. Goodyear's actually on the upswing. Goodyear, Arizona is on the upswing. It's up by 4%. Everything else has been trending down. Chandler's still at the top at 164. And if I don't, okay, so on the index, and the Crawford Market Index, Peoria and Cave Creek, those are in balance range. And then beyond that, Goodyear, even though it trended up a little bit, Goodyear, Surprise, Maricopa City, Queen Creek, and Buckeye are all in buyers markets. Everything else is in a seller's market, technically. Chandler topping that list. Okay, just to give you a quick idea. So on negotiations, you can kind of, we can get you more info on that. But right now we're looking at for this time of year right now, and a lot of people had have very high expectations sometimes when they sell their home. But we're looking at price cuts and this includes new home builds too. So they're offering a lot of deals right now just to close things out. We're looking at price cuts of around, when they're doing price cuts of around $10,000. That's the average. The 44% of people are paying seller concessions right now. Again, time of year too, things are a little bit slower, a little bit more apt maybe to get a good deal, but you got a serious buyer there, guys. And that puts us at about $9,500, using round numbers, about $9,500 on seller concessions. In other words, paying closing costs, maybe helping with buy downs for rates and things like that. So the median agent days on market to get to from this signing of a contract to get you on the market, to get you under contract, is about 33 days right now. Again, nothing out of the ordinary for this time of year. We had a question, are we getting a lot of foreclosures right now? We're not really seeing like anything nuts with foreclosures right now in the Phoenix area. Even as far as the country is concerned. Now, we had some people say, yeah, but they said on some news program I saw that foreclosures were up, like 300% or something. Yeah, because during COVID, we had the program where you could not allow a foreclosure. So when you get rid of that program, even if I go up to 30, properties or whatever the number is, that's going to be like a crazy percentage, but it's really overall not a crazy amount of total homes that are going into that situation. So percent of closings with seller paid concessions. We talked about that a little bit. One thing I would note is, let's see, we're looking, so nothing really crazy happening there. Again, it's the low end of that. I would say it looks like Carefree, Sun City, Paradise Valley, Sun Lakes, Scottsdale. Those are kind of on the low end, and then on the high end of it, Guadalupe, Youngtown, Coolidge, Waddell, Levine, Arizona City, Litchfield Park, Maricopa City. Those are all kind of on the percentage of closings, seller paid concessions, higher end, just to kind of give you a general idea of what's going on there. So you may see some range in, if you're in those areas, you may see that sort of range we're looking at. Percentage of closings with seller paid concessions noted from 300 to 400,000. I just wanted to throw this in there. 57%, which is kind of normal, again, are paying seller concessions there in that lower price range, which is kind of like, I would say, the low entry point for a home purchase in the Phoenix area. That's a really low, but looking at that lower end, that's what we're looking at. The median concession there is going to be about $9,000. The new listings year to date, we are a little bit lower than we were over the last couple of years, but again, nothing crazy. Let's see, active listings weekly counts. Again, we're seeing kind of the normal range there, nothing insane, for those type of this type of time of year during the holidays. Yeah, man. So one other thing I just wanted to show you guys, a couple other tidbits for our area here in Phoenix, just to make sure you realize, we're in a strong market here. And I could go on and on with these articles, but Blue Cross Blue Shield of Arizona going brick and mortar with proposed Valley network of medical clinics. So our medical, our technical, our tech industries taking off. There's all kinds of things happening here in tech. Developer plans to add 1,500 multifamily units to Peoria Commercial Center in the city of Peoria near Vistancia. A lot of that, that whole central Phoenix and even some of the Peoria area, that's all being huge right now because of the huge tech center, the Taiwanese tech center that's going in up in that vicinity. So that's bringing in a lot of jobs, bringing in a lot of businesses, bringing in a lot of homes and units there. Amcor plans a $2 billion facility in Peoria for packing Apple computer chips. Our tech and medical and construction industry is just huge here. And our entertainment, sports, we are a vibrant area, guys. We're always top of mark for real estate. And, there may be certain areas of town where we see some, commercial issues, like small little storefronts and stuff in certain areas, maybe in some of the older areas, there may be a little bit of that. But overall, our commercial sector is just exploding. Agriculture, another one, just huge. I wanted to show you this real quick, guys. This was last year, October, for rentals. This is for rentals. this kind of gives you the average units, okay, that where we're looking at. This gives you each month here broken down for 2022 all the way back to 2014. Just taking a look at that average units at 2021. I just want to show you this year over year with this, because people are asking about what about rentals. So the rental market has definitely crested, slowed down a little bit, but the average days on market 33, median lease is 21, average lease is 23, 24. And then when we look at this year, at the end of October, closing out October, we were at, let's see, we went from 2021 to 2,300 average units, so a little bit more. All right. And those average number of units going under contract each month, you can see it broken down here in the previous years, what those look like. The median lease, 2,100. Okay. That basically the same, guys. So we see that in the crazy selling and rental market we were in, things have kind of slowed there quite a bit. Doesn't mean that year over year a landlord isn't going to raise his rent a little bit, but we are going to. I mean, we were seeing rents go up $400, $800, $1,200 from 1 year to the next on lease agreements. It was insane in the previous year and a half, 2 years, guys. So this real quick, the average lease 2324. The average lease now at the end of October, 2,300. So a little bit more in transactions, but the average lease, average days on market, we went from 33 to 41. So it's taken a little bit longer to get properties under lease. So things just have kind of gone more to a normal balance, just kind of normal, not a crash, but just normal. There's actually more transactions there in that rental market there overall. So anyway, guys, I hope that helps you understand a little bit more what's going on in the market. Again, if you want more information about your zip code, your particular down to the neighborhood, community, or city, whatever, we'd love to be able to get you a home evaluation. We'd love to be able to talk about what you want to do next as far as where you want to move to and how we can help with that. Again, we'll get you set up with a wholesale lender, first of all, and just make sure that you're getting the best terms, the best rates possible on your home purchase. We can also go look at new build and what they're offering. And we have some creative ways of actually several creative ways where you can either get cash offers, full market cash offers. You can even move and buy before you sell and get your mortgage taken care of. Now, obviously, once you sell the property, you have to kind of pay those funds back, but it's sort of like a bridge loan setup. We call it our knock program. There's some just normal bridge programs that are available out there. Some of these allow you to fix up your home before you move, okay, with some of these cash programs, or move before you sell programs. Don't have to worry about all the showings and everything. Just kind of move on. That's nice. Get the property cleaned out, get the pictures taken care of and everything, and we get everything professionally done. So we've got a lot of different solutions, a lot of different options right now. It's an exciting time to be in real estate. Things are a little bit slower right now for sure, but they're just kind of normal. Next year, I think we're going to see, not like we saw a couple of years ago, but we are going to see a pretty huge surge and all that pent up demand and all these people who have been waiting because there haven't been any options or the higher rates or whatever. We're going to see that pent up demand start loosening up. And over the next 18 months, over the next 12 and 18 months, we're going to see a huge surge. So now would be the time to get into doing whatever you want to do and just gain that equity, guys. Gain that wealth through real estate. Let us know if we can help in any way. 480-788-8569. Check us out at McCulloughHomes.com, McCulloughGroup.com. And you can always email us at home@McCulloughGroup.com. We'll see you next time.